What's happening, my beautiful investors in training? Welcome back to another episode of the Do.Different.Better show, where we talk about wealth, wisdom, and money moves, making finance simple for everyday people. I'm your host, Elaine Rasmussen, CEO and founder of Social Impact Now, Connective Institute, and managing director of the Integrated Capital Fund, and your financial fairy godmother, here to sprinkle some wealth wisdom your way today. Today's topic is the bread and butter of financial literacy, understanding financial statements. These documents may look boring and intimidating, but they are the Rosetta Stone of any company's health and success. Whether you're an aspiring investor, an entrepreneur, or just curious about the company you work for, so you can know when it's a good time to ask for that raise or transfer, this episode will help you decode what these numbers mean and how to use them for your advantage. Here's a fun fact. I shared with you a couple episodes ago about the U.S. tax code being over 70,000 pages long, but did you know that a company's financial story can be told in just a few key documents? That's the power of financial statements. They simplify the complex. So first, let's start with the basics. There are three key financial statements that you need to know: the income statement, the balance sheet, and the cash flow statement. Each one tells a part of the company's story, and together they create a full picture of what's going on under the hood. Most of these documents focus on the past and the present. There's one more document I like to see, and that is projections. This document tells you about the owner's view of the future of the business. So first, let me break down some definitions. The income statement. It's also known as the profit and loss statement. It answers one simple question: is the company making money? It shows you the revenue coming in and the expenses going out and the profit or loss left at the end of the day. Think of it as your monthly budget. Money earned from your paycheck minus rent, utilities, and groceries equals what's left for savings, or in some months, what you owe on your credit card. Number two, the balance sheet. The balance sheet is the company's selfie. It's a snapshot of its financial position at a specific moment in time. It breaks down into three parts: assets, liabilities, and equity. Assets are what the company owns: cash, equipment, inventory, patents, you name it. Things that actually have value that could be sold and bring in more cash, right? Liabilities are what the company owes, like loans, accounts payable, or unpaid bills. Equity is what's left over that belongs to the shareholders once the liabilities are paid off. And shareholders can mean you as the only owner. It could be if you have partners, if you have relatives that are in the business. Those are all shareholders of the business, and they will share some aspect of the equity, whatever has been agreed upon in your incorporating documents. So here's a quick analogy. If the company were a house, the assets are everything inside. The mortgage is the liability, and the equity is how much you'd walk away with if you sold the house, right? So now let's talk about the cash flow statement. The cash flow statement tells you how money is moving, what's coming in, what's going out, and where is it actually going. It's divided into three sections: operating, investing, and financing activities. Here's an example. If the income statement says you made $100,000 in profit, but the cash flow statement shows a negative cash flow, it's like getting a really high paycheck, but realizing all your money is tied up in bills. Not ideal, right? So, why should you care about these documents? Whether you're an investor, a business owner, or someone trying to understand the world of finance, financial statements give you the power to make informed decisions. So, for investors, if you're considering investing in a company, financial statements tell you if it's profitable, stable, and growing, or heading for disaster. They're your crystal ball into the company's future. For example, would you rather invest in a company with rising revenue and manageable debt, or one that's consistently losing money? This statement makes this obvious, right? But there are some exceptions, which we won't get into, particularly when we're talking about investing in tech companies. Tech companies lose money for years before they become profitable. But that's a different level of return on investment. We probably won't get into that a whole lot today, but I just wanted to call that out because it is a very specific sort of asterisk on this conversation. So for entrepreneurs, as a business owner, these documents are your compass. They show you where your money is going, what's working and what's not. Think of them as your business report card. So, but even if you're not an investor or a business owner, understanding financial statements help you make better personal finance decisions. For example, if your favorite coffee shop suddenly raises the prices, the income statement might reveal that their costs for supplies have skyrocketed. It's like peeking behind the curtain and understanding what's happening in the business, right? Not just the parts that you see, meaning when you go to that coffee shop, it's busy or it's not busy, right? These documents will tell you actually what's happening because maybe you're just not there when it is busy, or maybe you're not seeing their online sales, but those are the financial statements will give you clues to some of these other things that might be happening. So here is something that I want you to think about. So how can you put all this into action? Well, here's what I want you to think about doing. Download a public company's financial statements. You can go to visit a site like the SEC.gov, or you can use your brokerage firm, or you can go to Investopedia to find a company's income statement, balance sheet, and cash flow statement. Start with a company that you're curious about. What's a product that you use all the time? Maybe it's Apple, maybe it's Tesla, or maybe it's your favorite retail brand or toothpaste or hair care product, whatever. If the company is publicly traded, you'll be able to have access to their financial statements. You can even go to their website. And if you scroll all the way down to the bottom, usually there'll be a little thing that says investor relations, or it might say financial documents. Usually it'll say investor relations or corporate responsibility. Sometimes under the corporate responsibility tag, you can get access to these information. But under investor relations, if you click on that, or you can type in to their search bar, stock shareholders report or stockholders report, and in those reports will be their financial documents, right? So, but I just want you to pick one statement to study. This can be overwhelming if you're trying to look at all of them and this is your first foray into this conversation, right? But just look at the income statement first, for example. It's usually the easiest to understand. Check if the company is making a profit and whether its revenue is growing. A lot of times with these publicly held companies, what they'll do is when you pull those documents, they'll show you multiple years at a time. They won't just give you the income statement for 1 year. They might do the previous 2 years or 3 years. And on their website, they'll generally have some historical information. So you can look at the most recent report from that report that you're looking at, and then you'll be able to see over time the 3 years previous to the 3 years that are reported in that particular document that you're looking at. So just within 2 documents, you might be able to see a 6-year history on the income statements of how the company is moving. And so it'll be interesting for you to see over time, is the revenue growing? Did they take some dips? What happened in that year? And many of those things are going to be reported in the shareholder documents of like, hey, there was a pandemic. Hey, there was an employment shortage. Hey, we had a high level of turnover in our employees. This impacted our productivity, which impacted our ability to move product or services, right? So you'll start to see how all of those things really start to begin to work together, right? But I want you to take away from this to not be intimidated by any of this, right? This is just a new set of blueprints that you're going to be looking at that you haven't looked at before. And because this is new to you, obviously it's going to be foreign, it's going to be confusing. But like anything, I'm sure in your job, when on your first day, you did not understand everything. And now you're a whiz. This is going to be different. This is going to be no different. You're going to actually have to make a practice out of looking at these so that you can understand them. And once again, even if you're not looking to be an investor, I think it's really good for you to understand these documents and look at them for your own company, not only if you're a business owner, but also if you're an employee. Once again, I've talked about this in previous shows. Understanding these documents will give you clues on when it's a good time to ask for a raise. When is it a good time to ask for a transfer? If you're trying to get to the London office, hey, what's going on in the London office? Look at their income statement, right? If you have different divisions that are in your organization or different strategic business units, see how that strategic business unit is doing. And if that's the business you're trying to transfer to, that transferring when their business is well is going to be a lot easier than transferring when that line of business isn't doing well. So this is how you can leverage whether you're looking to make investments or being an angel investor. But here's the important thing that you need to know. Private companies, you don't typically have access to their financial statements. Which is why I'm encouraging you to look at publicly traded companies, because that information is public. Oftentimes, if you're looking to make an investment into a private company, typically it is not uncommon that, one, you have to know whether or not they're looking for investors. They're not just going to hand over these documents to you. And two, often they may ask you to sign a non-disclosure agreement, which means you will not share anything that you see in the financial statements. You're not going to go on an Instagram. You're not going to go around and go to the Star Tribune and tell people what you saw about this company. You were signed. They will require you to. It is not uncommon that they ask you to sign a non-disclosure agreement so that they are protecting themselves around you telling their business or proprietary secrets, whether it's how they access new accounts, whether it's how they produce the actual thing that they make, whatever the case may be, is the non-disclosure agreement will be broad, meaning any information you get about the company is kept under seal. Now, the challenge with NDAs is, particularly for smaller companies, is you're actually now limiting my ability to actually talk with other potential investors. So if I am looking to invest in a company and I'm asked to sign an NDA, when I say a smaller company, I'm talking about a company that's under $2 million. If you ask me to sign an NDA, you're now hand tying me because I cannot talk about this business to somebody else who I think might be a better fit, or somebody I might want to co-invest with me. So these are all the things that you want to think about, not only as the investor, but also as the founder, of when and how do you leverage an NDA, or do you make the NDA clause in the NDA that says, if you are looking to speak to another investor, these are the parameters of which you can share. The investor needs to be introduced to the prospective investor needs to be introduced to you before information can be shared. Or you can make some caveats in your non-disclosure agreement, but the whole idea is to make sure that you're not hamstringing folks that could lead you to other elements of their network to be able to support you in the business. So we've now kind of talked about sort of the groundwork of financial statements, what they are, how they work, what kind of information. In the next segment, we're going to take a deeper dive into how to read these statements like a pro. We're going to be focusing on what to look for and how to interpret key numbers. Trust me, by the end of the episode, you'll be reading financial statements with the confidence of Damon John or Issa Rae. Stay tuned, my future financial wizards, because it's time to turn numbers into knowledge and knowledge into power. You're listening to Do Different Better. I'm your host, Elaine Rasmussen, and I will see you after the break. All right, welcome back, my savvy future CFOs. You're tuned into the Do Different Better show, where we make the financial world less intimidating and way more actionable. In our first segment, we covered the basics of financial statements. Now it's time to roll up our sleeves and decode the numbers. We're about to turn those intimidating spreadsheets into a treasure map for building wealth, spotting opportunities, and steering clear of bad investments. Here's a fun fact to kick things off. Warren Buffett is one of the greatest investors of all time and spends about 80% of his day reading financial statements. That's how important these numbers are. But don't worry, you don't need to spend hours in Excel to get the insights you need. So let's break it down step by step. Let's first start with the income statement, or as I like to call it, the money in, money out report. Here are the big three things that you need to pay attention to. 1, revenue or sales. What it tells you is the amount of money that the company brings in before any expenses. Here's a red flag. If revenue is declining over multiple quarters, it's a sign that the company might be struggling to grow. They haven't figured out their niche, or they're having trouble retaining customers, but it flags you to be able to ask them the question, hey, I've noticed that for the last 4 quarters, sales have been going down. What do you think is happening? right? This isn't about you having the answers, but about you coming up with really good questions that you can talk to with the owner or the founder to find out what's going on. Because maybe it's something that can be recovered from, or maybe it's something you have an expertise in that you can help them with, right? So if here's an example, imagine a coffee chain's revenue drops because a new competitor opens across the street. You want to dig deeper into why their sales are shrinking and what are they going to do about their unique value proposition with this competitor across the street. The second one is net income. This is the profit left after all the expenses are paid. Think of it as what's left in your wallet at the end of the month after all your bills have been paid. Here's a pro tip. Check the net income margin, which is net income divided by the revenue. A higher margin means the company is efficient at turning sales into profit, right? The third thing is operating expenses. They tell you, are they spending too much money on things like salaries, marketing, R&D? You can compare this to competitors to see if they're overspending or underspending. Now, you want to be careful about making comparisons, especially if you're looking at a small business versus a Fortune 500 company. While you want to know what is the industry trend, there are some industries like grocery stores. Grocery stores have very small margins. Electronic stores have very small margins. Furniture stores make very small margins. If the industry as a whole has very small margins and you're looking at a small business, a mom and pop shop, or a smaller business that is a furniture store or an electronic store, then it makes sense, because that is the industry trend. But if the industry trend is, hey, the margin should be 15, 20, 30%, and their margins aren't looking like that, well, then that's an eyebrow raiser, okay? When you're looking at the income statement, the key question is this company making money, and is it getting better at making money over time? If profits are consistent or growing, that's usually a good sign. Now, let's move on to the balance sheet, the selfie of the company's financial health. Here's what you want to focus on. First thing, assets. Assets tell you what the resources that the company owns. So once again, cash, inventory, real estate, patents, etc. Things that have value in the company. You want to look for steady or increasing assets. A sudden drop might mean the company is selling off assets to cover expenses. Let's say it's an electrical company. Over time, you see that in the last 2 years, they've sold off 5 trucks. Okay, that's a question of why are you selling off 5 trucks, right? And you're going to see that in the revenue line, because it's going to say sell off of equipment, or it'll have an equipment line, and you'll see that number growing over time. Well, why is that number growing off over time? It might be because they're selling their assets. The next thing is liabilities. This tells you what the company owns, whether there's outstanding loans, there's people that they need to pay, or if there's some long-term debt. And that doesn't necessarily mean that it's a bad thing. So I sit on the board of a $36 million social enterprise, and we took out $1 million loan to buy a piece of equipment that cost $1 million that we knew was going to triple our production, which allowed us to triple our sales. It was going to give us access to a new set of customers that will actually grow the business. So while on paper, yes, it's a big loan, but once again, somebody might ask us, well, you've got this debt on your books. Are you concerned about that? And then the answer would be, hey, we bought this equipment to increase our production, which will increase our sales, which will increase our bottom line. So and we know that this will be paid for inside of 3 years, right? These are the kinds of questions you want to raise, and that's the kind of answer that you want to get back when you ask the question. The next part is liabilities. It tells you what the company owes in loans or accounts payable or long-term debt. Look at the debt to equity ratio. That is the total liabilities divided by the shareholder equity. A high ratio means the company is relying heavily on debt, which can be risky. Because if that debt gets called, meaning it needs to be paid all at once, like a balloon payment, it could take out all the cash of the company, right? Or take the company under. Then the last part is shareholder equity. It tells you that what's left over for the shareholders after liabilities are subtracted from the assets. It measures the company's value. The balance sheet gives you a snapshot of stability. If liabilities are piling up and assets are shrinking, that's a red flag. But if equity is growing, You're looking at a company that's building value for the shareholders or owners. So once again, this could be you as the owner if you're a single ownership, or if you have partners or family members. As you see that shareholder equity section grow in the spreadsheet over time, then that means that money is being put into the company for those shareholders, and that's where the value is for the company, right? So here are some key takeaways from the cash flow statement. Last but definitely not least, let's talk about cash flow. You can think of this as the lifeblood of the company. Even profitable companies can run into trouble if their cash flow isn't managed well. So there are 3 key activities. First, operating activities. It tells you that cash generated from the company's core business operations. If this is consistently negative, that's a major red flag. Here's a tip. A healthy company should generate enough cash from its core business to cover its operating investments. And I say core business. So I had a company that I was looking at, and they had generated just as much money from grants as they had from sales. Now, you might, as a layperson, think, well, what's the problem with that, Elaine? Well, the problem with that is that's not a business model. If you are trying to have a high level of grants, then you are spending more time on your grants than you are on working on grants than you should be, as opposed to working on building the business and the product or service that you sell, right? So how are you spending your time? Because here's the thing that I also tell businesses as it relates to grants. Grants typically don't come back, right? There's very rarely a recidivist, you can get those grants again. A lot of times grants for entrepreneurs are a one-time thing. Getting a customer is a lot easier and more reliable for ongoing income and revenue, right? So you just want to be mindful of those kinds of things. Number 2, investing activities. It tells you that the cash spent on buying or selling assets like equipment or real estate or securities. What you want to look for is the company reinvesting in its growth. Consistent investment is often a good sign because they're confident that they're going to grow, whether that's new computers, more trucks, more cars, building up their fleet. Whatever the case may be, is they're seeing that there is a future or there's a demand that is calling on them to buy more assets to be able to service the market and do what they do or be productive. Lastly, there is the financing activities. What it tells you is the cash from issuing or repurchasing shares, borrowing, or paying dividends. A red flag is if the company is borrowing heavily to pay dividends, it might be a sign that the company's in trouble. So the cash flow statement answers one big question. Does the company have enough cash to stay afloat and grow? Without healthy cash flow, even the most profitable company can struggle to stay afloat, right? So now I really want to talk about how do we tie all of this together, right? So we've talked about the 3 big statements, the income statement, the balance sheet, and the cash flow statement. But let's tie it all together and imagine that we're looking at a tech startup and their financials. So income statement says revenue is growing 20% year over year, but expenses are eating into the profits. The balance sheet says there's lots of assets, but they're heavily leveraged with debt, meaning they have a lot of debt, and the debt might be outpacing what it costs to service the debt. Cash flow, they're burning cash from operations because they're reinvesting heavily in product development. Would you invest in this company? Well, the answer depends on your risk tolerance and how much you can afford or are willing to lose. If you believe in long-term growth potential and can handle short-term risk, it might be worth it. If you're risk averse, meaning you can't or don't want to invest in something that doesn't have a little bit more sure-footedness, then you might want to wait until the company stabilizes or move on to a different investment opportunity. Now, the last document that I wanted to talk about is projections. So I talked about this a little bit at the top of the segment. Projections, a lot of these documents, once again, tell you about the past and they tell you about the present, what's happening in the organization. Projections give you an insight into what's going to happen in the future. Now, projections are exactly what they sound. It is a projection of what they think they are going to do based on past activity or based on what they know is going to be happening in the market. So sometimes you may see, particularly on finance shows or television shows that are based on finance, where they're like, hey, there's going to be a ruling by the Securities Exchange Commission or SEC in March, and we think that it's going to be favorable around this particular topic, whatever the topic, maybe it's blockchain, right? So companies might start to say, hey, if that happens, we know that that will have a positive impact on our sales of our product or service. Therefore, we're anticipating X amount of increase in our sales in our projections because we believe that this activity is going to happen, which will favor our particular business model, company, whatever the case may be is. So, but when you're looking at projections, what I like to say, projections are made up. In large part, they're made up. So the question really becomes, how realistic or rooted in reality are the projections, right? So if somebody comes to me and says, hey, we have been doing $800,000 in sales. Actually, I was talking to a business that I'm looking at investing in. And when I asked about their historical revenue, they said we've been in business since 2019. Our first year of business was 200,000. Our second year of business was 400,000. Our third year of business was 600,000. Our fourth year of business was 800,000. And our sixth year, which is this year, we're on track to hit $800,000 again. First of all, what that tells me, that would show up on the income statement or the cash flow or the income statement or profit and loss statement over time, is they've been doing something right as far as gaining new customers, managing the business, and increasing their revenue. They're doing something right. The fact that it leveled off, right, meaning that the increase in sales wasn't exactly the first year. It was, they went from 0 to 200,000. They went from 200,000 to 400,000. They doubled their sales. It makes sense to me that over time, they didn't double their sales. Maybe instead of 200% increase in sales, they had 100% increase all the way up until their current year where they're actually stagnant, right? So the year before they made 800,000, they're on track this year to make 800,000. That is what I would anticipate would happen for a growing business, is that eventually they top out because they have a limited amount of resources and employees. It's a family-owned business. And they're looking for investors. So the fact that they're a family-owned business, very small team, it makes sense that they may have bottomed out on the top line of revenue that they can make, which is why they're looking for investments. That's what I anticipate. And so when I think about the future and I think about projections, I'm thinking about, okay, that rise that I've been seeing year over year is not going to be the same, right? So if I'm looking at a business's projections and they're doing their projections based off of what we saw in the first 5 years, that's not realistic. Now, do we know exactly what it's going to be 5 years going forward? No, but I'm pretty sure it's not going to be exactly what they did the previous 5 years. So this is how you want to look at projections. You want to think about how grounded in reality are these projections? Are they projecting that they're going to hire 20 people in a year? If they're a small business, how realistic is that? I can tell you right now, it's hard. Unless they're a tech-based business where they know they're going to be getting an infusion of capital that's going to allow them to pay all those salaries, hiring 20 people in a year in a small business to grow the business is like unrealistic. So what is realistic is really going to depend on the industry. Every industry is going to have a little different lens on what is realistic for that particular business. And this is where industry reports come in. This is where looking at some of the larger competitors and seeing how those businesses have grown can give you an indication as to maybe looking at a smaller business of what is actually the sort of, what is the nature of growth, or what is the standard level of growth for a business over X amount of period of time, right? Whether it's the first 10 years, the second 10 years, the third 10 years, businesses grow at a predictable rate and scale. And is this business when you look at their projections, kind of following that sort of trend? Maybe not exactly, but they're on par to follow that. So I really love projections as sort of that cherry on top of the ice cream sundae to be able to really give this full picture of, I'm looking toward the past, I'm looking at what's happening now, but I'm also looking at what are they thinking as far as the opportunities for the future? And are those opportunities that they're thinking about realistic as far as their capacity, their capability, their willingness, their talents, and their skills? Then I can sort of make this 360 view of like analysis of what do I think of the company, and if I'm looking to invest or partner or mentor or strategize with that particular business. So now that we're just to wrap up this segment, you've been listening to the Do Different Better show. I'm your host, Elaine Rasmussen. In the next segment, we're going to talk about questions you should ask when reviewing these statements and how to use them to make informed investment decisions. Don't go anywhere. You are just one segment away from mastering financial due diligence. I'll see you after the break. Welcome back, my financial detectives. This is the Do Different Better show. I'm your host, Elaine Rasmussen, and we're in the final stretch of today's episode on understanding financial statements. We've talked about what financial statements are and how to read them. Now we're diving into how to use these documents to make smart investment decisions and the key question to ask before you take the plunge. Remember, financial statements are more than numbers. They're a story about a company's health, their strategies, and potential. But just like any story, you need to ask the right questions to uncover the truth. So let's dive in. First things first, what should you be asking when you sit down with these documents? Here are some great questions to guide your evaluation process. They're not the only questions, but they're a good set of questions that you can start with until you really get to more comfortable being able to look at data and create your own questions, right? Is the company profitable? What did the income statement tell you about the profitability trends over time? Things to look for is consistent or increasing net income, right? It's okay if it dips a little 1 year or 1 quarter, but what you want to do is look at that over time, right? That's going to give you a clearer picture, right? 2, is revenue growing? Revenue growth can signal that the company is capturing market share or expanding its reach, right? And figuring out what's driving that growth. Is it organic sales? Is it acquisition? Is it pricing increases? Is it new market opportunities? Have you created a new use for your product? I had one founder who I was working with, they had a cocktail mix. And when they shared the cocktail mix, I was like, I wouldn't use this as a cocktail mix. I think it would make a great soup. And so literally doubling his product without even changing the recipe, he's now got a product that is a cocktail mix, but also can be a soup, right? If he decides to do that, right? But once again, he's doubled his market share by literally just repackaging the same product with the same recipe. He just needs to make more of it, right? The other question that you can ask is, how much debt does the company have? Use the balance sheet to evaluate the company's debt load. Ask the companies to generate enough cash flow to cover its liabilities. Number 4, is the company efficient? Efficiency ratios like return on assets or ROA or return on equity ROE can reveal how well a company uses its resources. Are the ratios improving over time or are they stagnant? 5, what's the cash flow story? Look at the cash flow statement to see if the company generates consistent cash from operations. Ask if the company's reinvesting the cash wisely or burning it over to cover operating costs. Asking these questions helps you avoid relying on gut instincts and shiny headlines. Instead, you're basing your decisions on cold, hard data. And trust me, that's where the magic happens. Once you've answered your questions, you've asked your questions, and you've gathered insights, it's time to make decisions. Here's how to use the financial statements to guide your investments. Number 1, spotting red flags. A sudden spike in debt, declining revenue, or inconsistent cash flow could indicate trouble. For example, if a company's cash flow is negative, but they're still paying high dividends, that's a red flag. Dividends to the shareholders. Once I was looking at investing in a company, and once we got this wouldn't show up necessarily on the balance sheet, but once we got the tax returns, because once you get to a certain level of due diligence, you get to ask for tax returns. It turned out that basically the owner who was selling the company had taken out most of the equity in the company, right? He'd already cashed it in and taken it out. So, but he was proposing that with the sale of the company that he would keep all the accounts payables that were outstanding since he had earned that business. And I was like, well, you've already taken equity out of the company, all the equity that's in the company, and you want to take the receivables. That will mean that there will be no cash in the business. So what are you selling me? So these are kinds of things that you want to triangulate and think about as you're thinking about investing. But number two, comparing companies. Use financial ratios to compare the companies to its competitors. Tip, if you're looking at two companies in the same industry, the one with the stronger profit margins and lower debt is generally the safer bet. Number three, evaluating your risk tolerance. High growth companies often come with higher risk. Using the financial statements to decide whether you're comfortable with these risks is going to be important. For example, a tech startup might show explosive revenue growth, but no profits. Is that a risk you're willing to take? You know, Pandora didn't make money for the first 10 years it was in business. So can you withstand not getting your investment back in part or in whole for 10 years, right? These are the things you want to think about. Number four, timing of your investment. A strong balance sheet and consistent cash flow might signal it's time to invest. Here's a tip. Look for companies with clear plans for growth, projections, as outlined in their financial or shareholder letters, right? The more you practice, the easier it's going to become to spot patterns, understand trends, and make decisions that align with your goals. So now that you are equipped with the know-how, let's talk about the tools and resources that make financial analysis a breeze. So I've got a long list here. So get out your pen and paper or your favorite digital device. One is online platforms. There's Yahoo Finance, Morningstar, Bloomberg, Investopedia. They offer easy access to financial statements and analysis tools. And here's even a pro tip. Use their comparison features to evaluate companies side by side. Now, once again, these are going to be public companies. If you are looking at making it a smaller investment or investing in a private company, those are going to be one-on-one conversations that you're going to need to have with the owner. And like I mentioned before, don't be surprised if they ask you to sign a non-disclosure form, right? So number two, there's financial literacy book. Here's some recommendations. I've talked about these before. The Color of Money is Black, The Intelligent Investor, Common Stocks and Uncommon Profits by Philip Fisher. These are some great ones. The classics break down how to use financial statements and find great investments. But even just understanding how money in the financial system works is also going to be great for you. 3, portfolio tracking apps. Personal Capital and Stock Rover help you monitor your investments and assess process performance over time. Investopedia actually allows you to create a fake portfolio by giving you, I think, $100,000 that you can play with. They've gamified investing. So you can really start to get your toe in the water around company evaluation, what kind of values you want to hold in your portfolio before you take it to the real streets, right? So here's a tip. Use these apps to track financial ratios and trends so you can make informed decisions. Then there's finally professional help. Sometimes a CPA or a financial advisor can also help you provide you with valuable insights. The banker at one of the banks that I bank at for one of my businesses, I'll do a shout out to Drake Bank. They do a really good job. Scott, who is my commercial lender, if I want to say, hey, Scott, can I get your opinion on something real quick? He is happy to just kind of give me like, hey, just looking at this, here are a couple of red flags that I see. He does this every day, day in and day out. He looks at financial documents. So he's going to spot something a lot faster than even me of what some red flags that I might overlook. So getting him as a second opinion is always amazing. So building a relationship with your banker is always great because they're going to be able to give you some insight as well. So here's an actionable step. I want you to schedule a consultation to review the findings review your findings and get professional advice, maybe from the company that you work for or a company that you're thinking about. Once again, looking on Investopedia or sec.gov and pulling the financial documents for an organization, right? Maybe the CFO in the company, take that person to lunch or coffee and say like, hey, look at this financial statement and what red flags do you see or what opportunities do you see, right? That they'll appreciate that. They love being taken out for coffee. Nobody takes the finance team out for coffee. So now let's really talk about benchmark financial ratios, right? So I talked about looking at industry standards for different industries, and what you're going to see at a public company is going to be very different than what you see at a small company. But it's really essential for you to understand, what does that particular industry look like? Because each industry has its own sort of norms and benchmarks. But here's some of the best ways to learn about some of this information. Industry reports and market research. So there's sources like IBIS World, Statista, or S&P Capital IQ. Some of your libraries, whether the college library or public library, may have access to some of these. They may have subscriptions to these that you can use and get access to this for free. Some of them are for a fee. Some of them are free, or they're free for a certain amount of period. But your local library or your university library may have access to them for free. So check that out. They offer reports like industry-specific financial benchmarks, trends, and key performance indicators. Trade associations and industry groups are another good way for you to get information. So they offer, there's examples are the National Restaurant Association, American Bankers Association. These industry average benchmarks, they provide they offer industry averages, benchmarks, and key data for members and the public. Check out the annual reports and newsletters for free benchmark insights. Next is financial data platforms. So there's Bloomberg, Morningstar, and Yahoo Finance. What they offer is access to financial ratios like price to earnings ratios, debt to equity ratios for public companies in specific sectors. And here's a pro tip: use their filters to compare companies within the same industry to identify certain trends. 4 is SEC filings and financial statements. So you can use Edgar, which is the SEC's database, to review financial statements from publicly traded companies. They offer some really great insights into financial ratios for the industry titans of particular industries. And they look for the management decision and analysis, their MD&A section, for the insights on industry-specific financial performance. And lastly, but not least, there are books and educational resources. So there's Financial Intelligence by Karen Berman and Joe Knight. They talk about general ratio analysis. And then there's RMA Annual Statement Studies, which is an industry-specific ratio. So you can kind of see what's going on, right? So just a few more. So there's online courses and tutorials like Coursera, LinkedIn Learning, Udemy offer courses on financial analysis and industry benchmarking. There's this show. You can always come back to this show. If there's something you really want to know about, let me know and we'll make sure that we do a whole show on that. But they offer you tutorials or specific tailored to specific industries around these financial statement analysis. There's also accounting firms like Deloitte and PwC, Ernst & Young, KPMG. They also issue reports and thought articles about different kinds of benchmarks for different organizations. Then there's benchmarking services like BizMiner, SageWorks. I know I'm getting really deep into the weeds, but I really want you to have a full breadth of where you can go. There's no shortage of resources to be able to access information to understand different kinds of industries, even if you just want to start with the industry that you currently work in. Then there's also just peer analysis tools like Finbox and Simply Wall Street. They can also offer you side-by-side comparisons. But once again, if you're looking at investing in a small local business, use the larger business to give you clues as to how you might want to think about this smaller business. Obviously, the smaller business isn't going to be on the level or the revenue stream that a larger company is, but it'll tell you like, hey, well, how are you thinking about this, knowing that this larger business is conducting their business this way, right? And then finally, there's networking and professional groups. So there's CFA Institute, which is Chartered Financial Analyst Institute, but there's meetups. There's all different kinds of meetups you can find on Eventbrite, Nextdoor, or other sorts of things. They give you great opportunities to learn from experienced analysis. But here's some great steps to get started. Select an industry, gather data, compare and analyze, and practice, right? So, all right, my financial detectives, you've got all the tools you need to uncover the story behind the numbers. Remember, the financial statements aren't just reports. They're the truth serum for the company you're considering. Ask the right questions, dig deep, and don't be afraid to walk away if something doesn't add up. Your next step, review a company's financial statements this week and apply what you've learned. Thanks for joining me on the Do Different Better show. I'm your host, Elaine Rasmussen. If you loved today's episode, share it with a friend, leave a review, and hit that subscribe button with somebody who's ready to make a difference with their money. You can watch this in previous episodes on YouTube at Do Better with Elaine. Let me know what you think of the show. We love the comments. Tell us how this has helped you. And if there's somebody you want me to interview, hit me up on LinkedIn or Instagram at Do Better with Elaine. I'll see you next week, and I'll show you how to do different better.